Hey everybody, and welcome to another episode of the Business Barbershop Podcast. I am Chris.
I'm Keane.
I'm Barry Varshay.
That's right. We have a special guest with us today, Barry Varshay. I met him actually last week when we had technical difficulties for about 95 seconds. And so I'm excited to have him back here today with all the tech fixed.
So I kept having an office in Renton. I get people stealing the copper from our, I think what was the news that 40 cars were broken into? Did you guys read that in one night?
I don't know. I kept getting alerts that my Renton office had no internet, and I was just like, well, yeah, I'm not down there. So
that was last week, but last weekend, I want to say there was 40 cars broken into all one night.
Yep, I believe it.
Yeah.
I believe it.
Yeah.
All right, then we're here today to talk about some kind of real estate stuff. I'm not sure what I warned Barry that we would do and that we're going to do right now is just have him give like maybe a little short intro, just like who are you and what do you do, that type of stuff. And then I know Keane has some specific things that he wants to talk about with you, and I'm just gonna chime in whenever I can. So Barry, tell us a little bit about yourself.
Great, thanks. Yeah, Keane, I worked with Keane for a couple of years. He actually got referred to me by a real estate agent that we both know in common, and she said, "You are two of the smartest guys I know, and you should know each other." That's how we actually met, which is kind of a funny story.
Yeah.
I've been a full-time loan officer since 1989, so it's been a minute. And, obviously seeing a bunches of cycles with higher rates, lower rates, and back and forth a number of times. So I've been following the market and the trading in mortgage-backed securities as just kind of a hobby. Since the technology evolved that allowed us to do that, which was in the late 90s. So it's been a daily market watcher and interested in all things economic and what drives the market and rates.
Love it. Okay. I know you guys are going to talk about some Fannie Freddie type of stuff.
Yeah. So again, this conversation starts with a Britney Spears reference, because most people may only know the term conservatorship because of Britney Spears, right? So a conservatorship is where a conservator, which is someone who manages a conservatee's finances, including limited spending, basically is granted and control of an entity. Now, in the story of Britney Spears, it was very much she's not mentally sound to manage her money, so her dad became a conservator in a conservatorship, if you will. I'm going to summarize the conservatorship that we're referencing, and then I'm going to let Barry kind of run from it, and we're going to kind of do some predictions and stuff from it.
Can I interrupt you real quick there, Keane?
Yeah.
I'm really glad you wanted Britney Spears as far as conservatorship and not with everyone's been expecting rates to go down for a long time. And I was hoping you weren't going to go with the hit me one more time.
Nice.
So
conservatorship
is better.
Yes, the big conservatorship that we're going to talk about today is referencing to two agencies, Fannie Mae and Freddie Mac, which are two. It's a duopoly businesses that are government sponsored but not government controlled. So I'm going to give a really, really quick history lesson to it, which I'll do as fast as I can. Back in the early 1900s, all mortgages were private portfolio loans, the way that people pictured loans to be, where a bank gives a loan and there's a term to it and they expect your money back. And there was massive liquidity and bank failures that happened during the Great Recession. And not the Great Recession, the Great Depression, sorry, wrong era, the Great Depression. And that began, and President Roosevelt signed a bill that allowed government-insured home loans, which was the beginning of FHA. And that was also the beginning of Fannie Mae. So FHA was this federally insured program where you can get loans of a certain type insured by the government. So banks would, provide a loan, it'd be insured by the government, and then they could take that note and sell it to the secondary market, which was purchased by a company called Fannie Mae. At the time, Freddie Mac didn't exist. And that process of securitizing that loan, turning it to a bond that was backed by the government, became a liquidity event to help allow people to get financing and to bring up banking again. And so Fannie Mae and FHA were very closely tied back then. And a few years later, they started securitizing other loans for the veterans coming back from the war, World War II. Those were the VA loans. And then they started creating a conventional product that was also purchased by Fannie Mae. So this operated that way all the way to 1971, where this giant, basically government-insured monopoly was securitizing pretty much almost every loan in America, conventional loans, FHA and VA loans, and that was the beginning. And so they realized, okay, this is way too big, and it technically violates our monopoly laws and so forth. So we're going to break it up. And that was 1971, and they broke it up into 3 entities. Ginnie Mae was what the original Fannie Mae was, but was going to stay government controlled, only take the government products like the FHA, VA, and some other products that came around. I don't know the history of when USDA loans happened. Barry, you might, HUD 184s. They kept all the government insured product, and they took the conventional product, which was supposed to be a private product, and then broke it up into 2 entities. Fannie Mae continued to exist for that conventional product, which was the bulk of their business. But because it couldn't be a monopoly, they wanted it to be a sister company, which was the beginning of Freddie Mac. So Fannie Mae basically got split to 3 entities: Fannie Mae, Freddie Mac, and Ginnie Mae. And the Fannie Mae Freddie Mac duopoly to securitize a big bulk of American home loans has existed that way from 1971 till today. And then what happened in the Great Recession is they were both set to fail because of the banking issues we had from the subprime era, right? And so government came in and saved them in a couple different ways. One, by buying the bonds. The Federal Reserve was buying the bonds, and also placing those 2 entities under a conservatorship. And it's been that way. Gosh, when did that get placed, Barry? 2010, I think, 2009.
Yeah, because basically Fannie Mae and Freddie Mac were losing so much money that they had to turn to the federal government to remain operating. And so the federal government, when they stepped in, at the same time, or they were doing TARP, the Troubled Asset Relief Program. Basically, they had to invest so much money in Fannie Mae and Freddie Mac to keep them stable and liquid that they ended up owning 80% of the shares.
Yeah, and so in an odd way, coming out of the Great Recession, even though it was 2 entities and part of a 3-entity split in 1971, in some ways we all kind of felt like you can call it 3 entities, you could kind of operate them independently, and some of their guidelines and all that stuff are definitely independent to each other. But it very much felt like those 2 were back and controlled by the government because they basically bailed them out. And that conservatorship still exists to this day, even with all the real estate boom we've had from 2014 moving forward, all the extra boom we had from COVID. And there's a lot of pressure in the news right now to end that conservatorship, including some of the recent people who supported Trump. Bill Ackman is a big advocate for it. And that is the extent of most of the knowledge I have in that space. And so I thought, as the news comes about ending this conservatorship, I want to know more about what that's going to do for the market, having them operate independently. And what's interesting now is what's happening in the market is there's a real push for more private options away from Fannie Mae and Freddie Mac, which is what the subprime loans were, from 2000 to 2008. And in their own way, they've kind of come back in the form of what we call non-QM mortgages, underwritten a lot more safer than the subprime stuff, but it is a large group of privatized products that are sold to Wall Street that are not backed by the government, and those have kind of came back roaring and have taken up quite a bit of the market share again. So that's a stage I'll leave with you, Barry. I don't know what it means for that conservatorship to come to an end. But let's I want to hear your insights on what that looks like and what that's going to mean for the market.
Great. So first, let me back up just a little bit for anybody who's watching this that maybe doesn't have a ton of time in the mortgage industry. As far as why does this matter? And the reason it matters is because when you go to get a mortgage, most home buyers, they go on and they want a 30-year fixed rate mortgage. Most people don't understand that is a uniquely American product, by the way. If you're in Canada, you can't get a 30-year fixed rate mortgage. They don't exist.
Yeah, they're all arms.
They're all arms. And so the where mortgage money comes from is not the bank that does the loan. So you could go to Bank of America, you're not borrowing Bank of America's money. You're borrowing Fannie Mae's money or Freddie Mac's money or Ginnie Mae's money 95% of the time. Occasionally the banks will do a portfolio loan where they keep the paper, but most of the time what happens is as these banks are doing loans, they're stacking up the notes and they gather a big stack of those notes and they put it into what's called a pool. And that pool of loans is sold to Fannie Mae. You don't make your payments to Fannie Mae, but they actually own the underlying loan, which means that the bank that loaned all that money out can turn around, get their money back from Fannie Mae and recirculate that money. So it's important that Fannie Mae and Freddie Mac continue operating for two reasons. One, because the banks can't handle the interest rate risk on their own, as we saw with First Republic. First Republic was a bank that just went bankrupt like 2 years ago because they did a bunch of really low fixed rate loans. And then when rates went up, those loans became worth less than zero because they had to borrow the money at a higher cost than they were charging customers for it. So the banks can't afford to lock up money for 30 years on a liability standpoint. And then additionally, if they loan out all their capital, then they don't have any money to continue loaning. So they need to basically securitize or turn those mortgages into a bond like Keane described so that they have their cash to turn around and make more loans again. So part of it's important because that's where we get a fixed rate from. Part of it's important because the banks have to have liquidity to continue operating and continue to have new mortgages available to the public.
Yeah, and if you think about it, almost every mortgage is customized a little bit, even though the bond is the same, because the loan amounts could vary, LTVs are different, FICO scores are different. So the way I describe it to people is it's really like custom order retail, right? It's like if you go to Savile Row and you ask someone to make you a custom suit, it's still retail. They're going to give you a cost of goods, but they're going to make it tailored to you. And that's what these mortgages are. We're tailoring the mortgage to fit the guidelines for Fannie Mae and Freddie Mac, funding the loan with the expectation the bank's going to turn around and sell that on the secondary market back to the agencies for a profit. So it's really just reverse retail. They fund it and they get it back for a profit, right? It's a cost of goods business. And so it is a unique product for the U.S. And we're blessed to have it, quite frankly. It causes some issues in its own ways, but as a whole, I think it's a good thing and really helps prop up our real estate market. So that's a,
yeah.
that's
So
good.
if we go back again to why this is important, nobody in the federal government was thrilled about TARP, the Troubled Asset Relief Program. That was the one that was demonized as the $700 billion bailout back in the day. You might remember the number more than the acronym. And a lot of people thought it was a huge corporate giveaway. But what people that didn't understand how the market functions didn't appreciate is that, I'd say probably close to 90% of the loan volume that happens on a daily basis is ending up at one of these three agencies: Fannie Mae, Freddie Mac, or Ginnie Mae.
What's the percentage? It's over 90, right?
Oh, it's very high. It's very, very high. I think the only thing that might bring it down a little bit is there's a certain amount of I shouldn't call it subprime, non-QM lending that's happening. That's more popular now, which doesn't go to the agencies. But
they're primarily just two categories. The majority of that non-QM space is going to be your jumbo loans. And I think that the one that's really grew a lot is the DSCR investor product.
Yeah, correct. But for your regular mom and pop, your regular first time home buyer kind of thing, Fannie Mae, Freddie Mac, and Ginnie Mae are the only games in town, really. All that mortgage volume is going to them. So when they ran into major liquidity trouble, it was looking like they might have to cease to operate, which I can tell you would have basically probably forever changed the mortgage industry as we know it. I mean, it would have been really, really, really ugly. Every independent mortgage company, I work for an independent mortgage company, CMG. Keane works for an independent mortgage company, Cross Country Mortgage. I can tell you companies like that would have ceased to exist basically overnight if Fannie Mae and Freddie Mac had gone away. So that would have left a handful of big banks that maybe had some capital. The other problem with it at that time was, and the reason for the bailouts, is when you're a big company, when you're a big bank, you can choose whether or not you want to make loans. As the CEO and the board, you can say, hey, this is looking a little risky. I think we need to back off right now. We need to tighten guidelines. We need to, to pull back a little bit. They can do that as an individual company. And the banks were doing that, honestly. Even the big banks, I worked for Countrywide and Bank of America at the time, and they had some of their own money to lend, but they were telling us as salespeople for the organization, do not sell our portfolio product. We don't want it. Go out and do Fannie Mae, Freddie Mac deals, because they didn't want the liquidity problems either. And so even the ones that had the money to lend didn't want to lend the money in that environment. So saving Fannie and Freddie was absolutely crucial to the American economy. And to their credit, I'm one of these people that actually thought TARP was a brilliant program. I'm in the vast minority in that viewpoint. But it, when you look at the effects that it had long term, it actually was a brilliant maneuver that pretty much saved the economy from going from a ugly recession to a Great Depression.
There's a lot of things during 2008 that people criticized, and they obviously could have done some things better, but there was a handful of things that everybody were saying they were doing wrong, and the government actually did correctly. I think, I don't know if they did on purpose, but the whole, do you guys remember the zombie foreclosures where there's these people who were in default and the government realized we shouldn't keep foreclosing on them because there's no one to buy them. So we're going to just let them stay there and not kick them out. And then I was wondering to myself, like, what's the outcome of this, right? I mean, you're just delaying the inevitable, and everyone kept on talking about the shadow inventory that's going to crush the housing market. But what they did is they just held on to it, and then there's a cycle where people who went through the first wave of foreclosures started qualifying and buying, and right when those people started coming back, they started slowly releasing that shadow inventory. And what we forgot is there was a shadow inventory of buyers, right, Barry? It's like all those people who went through foreclosure, they didn't jump off a bridge, kill themselves. They went back to work, they cleaned up their credit, and they entered the housing market again at a reduced cost and interest rate basis. And they consumed all that shadow inventory. And I remember looking back at that thinking like, hey, these guys actually, whether they meant to do that or not exactly that way is to be determined, or maybe it's something we'll just never know. But, they expected the housing market to keep going much, much further down because that quote, shadow inventory, and they forgot there's a shadow inventory of buyers, and they just were holding it for them to come back to the market and start releasing it. And that kept it from, coming down a lot further. So I think they did a lot of things right when, in hindsight.
Precisely. Yeah, because there for a while there was all these homeowners that had their 2 or 3 years in the penalty box for having gone through a short sale or a foreclosure, but then they became new buyers again, and so they started releasing inventory at that time. So the thing that's important about understanding what happened in 2008 is that is how Fannie Mae and Freddie Mac ceased operating as private companies with the kind of an implicit government backing. So the talk now is about, well, shouldn't we return Fannie Mae and Freddie Mac to being private companies? Because right now they're 80% owned by the government. The government owns 80% of the shares of the stock. And so the government basically controls them. And the benefit of having government control of these agencies is that the debt that they issue in way of bonds is viewed as being very interchangeable with the U.S. savings bond or T-bill, any other government bond, because it is, in fact, backed by the government at this point. So the discussion is that shouldn't we basically get the government out of the home loan business and turn these back into private companies? That sounds simple on the surface, but it's not, because they are very much intertwined at this point. And if you just cut the leash and turn Fannie Mae and Freddie Mac loose, one, they don't have the capital to operate. Two, they lose this implicit government guarantee of their debt. And all of a sudden, if you go to the market with bonds that say, by the way, we're no longer under government conservatorship, so nobody's guaranteeing these bonds. And by the way, we don't have a lot of capital to back these bonds up either. That basically moves that from being a AAA rated bond product to a triple B, because it now goes from being a AAA rated bond to a junk bond, basically, because the companies don't have the financial backing for those security instruments that are being issued to Wall Street to really be worth anything. If Fannie Mae and Freddie Mac lose that government guarantee, they would almost certainly lose their AAA rating.
Can I ask you guys a question?
Mm-hmm.
Maybe I missed this. Why are we talking about this? What I mean is like, has someone decided that it's time to move this back?
It's coming with the
news?
political shift. Yeah. The new political changes. There's a push for it. I mean, it's interesting is because even though there's a conservatorship, and Barry could speak to it, I have no idea how this is the case. Under the conservatorship, they're still traded on Wall Street. You can look at this, their ticker price, right? And I was looking, and the current stock price is right around $5-6 a share. The last time I was at that price before the big subprime boom was right when you got into business, Barry, before I got into business, like 1989, 1990. And then during right after the going into like the 90s, it jumped up in the $50-$60 range, stayed in there all the way to the early 2000s. And then of course crashed, from $60 a share down to $1 a share, 95 cents in October of 2008. So it went from $60 a share to 95 cents a share, and has been trading between $2 to $6, $2 to basically $1 to $2 a share.
Which is where it
ever
should
since
be.
then. Yep. And then in just recent time, because of the conversation of it becoming back to a public entity, the stock price has jumped up to the 574 it's traded at now. And so, so I guess it adds a couple of things. Is like, is this, is this a move to make it private? Is it really going to happen? I mean, the market's hedging it's that it's going to a little bit, because obviously the stock price is multiplied 3 times over in the last 2 months. But if we also thought it was going to get anywhere near where it was, I don't think that exactly what it was in the early 2000s is what it'll go to. But if it went anywhere near what it should have, if there wasn't ever a crash, I would imagine it would still be substantially higher than where it's trading at now. We don't know, is it going to happen? And also, what does that, that's a little bit of a question about whether or not people want to buy into the stock price, but also whether or not what that does to is a bigger impact that you and I understand, is that it has a bigger impact to the whole real estate market.
Yeah. So basically, to touch on that, Fannie Mae and Freddie Mac were privately traded companies. They had stock you could buy just on the market, and it was in fact a very popular stock to be owned by retirement funds and mutual funds, because it paid a very regular dividend, and it was seen to be a pretty conservative play. Just a very predictable, makes money kind of stock. When the government basically took over conservatorship of these companies, it was kind of a de facto move, because they injected so much liquidity that they ended up issuing new stock. So all those original shares are still outstanding, but now they only represent 20% of the value of the company, because the government injected so much capital into them that they ended up diluting the original owner's stock with all this additional capital investment. And so those initial shareholders are still there. And the push is some of those initial shareholders are like, hey, shouldn't we return this to a state where our shares might actually be worth something someday? I think that's kind of a silly argument. The only reason they're not zero right now is because the government stepped in. And
95 cents a share, they were clearly on their way to zero.
Yeah, they were on their way to zero. And now some people are complaining that they should take them private so their shares can go back to $50 or $60 a share. but and kind of conveniently forgetting the fact that they should be zero had it not been for the government intervention. Why does that matter? Right now, because Fannie Mae and Freddie Mac have this government backing and government ownership, they're still considered to be a AAA investment. That's the highest bond rating you can get. That's the safest bond you can buy. And because it's a safe bond, the interest rate's lower on it. Just like anything, if you buy something that's high risk, you expect to get a higher return. If you buy something that's low risk, you're okay with a lower return because there's very little risk. If the long and short of it, most industry analysts, the people studying this at the Fed and for the Congressional Budget Office have estimated if you take Fannie Mae or Freddie Mac private, rates will go up between 3/8 and 0.5% almost overnight, for no other reason than the implied risk. So no change in the economy, no change in policy, just the fact that there's a higher implied risk, rates would go up 3/8 to 0.5%.
And it's mostly just because people like the government attachment to it, which is why T-bills still trade at the lowest yield, right? The whole idea of investing in the T-bill is that you're not going to get the best yield, is that you're just going to get the safest yield because you're basically investing in the U.S. government. And I think the sales pitch for Fannie Freddie was they were private, but they were close enough to the government that they're always going to be considered too big to fail. So it's the second best thing or third best thing. I guess the second best thing might be like an FHA or VA mortgage backed by Ginnie Mae because it's officially still owned by the government, insured by them, right? And that this would be that next tier down, both securitized by real estate, backed by the government, so forth. Maybe not quite as secure as a T-bill that literally its success is driven purely on the existence of the U.S. government. But the next tiers look like these, which is why they typically, in that order, T-bills typically have a lowest yield. The government insured the home loans typically have a lower yield, and then these Fannie Freddie conventional products are higher than that, but they're still all relatively low, right?
Correct. Yeah.
So you pull off that security, the yield has to go up because it's an appetite for the investor. Do we want a big, are we okay with the current yield if the government attachment is gone, right? Correct. Don't you think Wall Street's a little bit smart enough to identify that these entities are still too big to fail, and that even if they unattach themselves, that if they got really bad, they're going to just go back in and save them again? I would imagine that would happen.
Yeah, but and this is where the devil's in the details. So, Chris, I'm going to ask you to just hang with me here a minute. This is going to get super nerdy. Okay, so the trick.
I'm a big nerd, so I'm ready.
So the trick on this is the how. The investors will see the why. Why do they want Fannie Mae and Freddie Mac to go private? Because their shares are worth something again. Okay, and people who are in the pro camp for this say, well, without government control, they can go innovate. They can go do things without having to check with the government first. They can go be more nimble or more flexible. Being nimble and flexible is what got them in trouble in the first place. Yep. So, I don't know that's necessarily a good thing. But that's the pro camp that's basically saying these are the reasons they should go private. And the Trump administration has been really big on they should go private. So that's why the now, okay? But the bigger issue is the how do you go private? How does this market continue to operate? Because our mortgage industry doesn't operate as a BBB rating. It doesn't. Rates would be so high that it would crash the real estate market. So how do you remove the government without losing the rating? And that's what people put a lot of study into. And the way they plan on doing that is by issuing another bond in addition to the mortgage-backed security. So there would actually be two different bonds issued. One called an MBS, or a mortgage-backed security. That's where the money for the mortgage comes from itself. And what the how part of how you take them private is they want to have a separate bond issued called a CRT, which doesn't stand for critical race theory. In this context, it stands for a credit risk transfer bond. And basically how that bond works is it typically has about a 9 to 10% yield And that was a 9 to 10% yield when rates were at 2. So, that 9-10% yield is probably not the right number anymore. It's probably got to be closer to 11-12% in the current marketplace. But basically what this credit risk transfer bond does is it acts almost like homeowners insurance for your house. If you have homeowners insurance on your house, hey, if there's a fire or an earthquake or something, and it's probably more like earthquake insurance now that I think about it. If you have an earthquake, you're going to have, and you have earthquake insurance, you have a relatively high deductible. Most people's deductible on earthquake insurance is like 10%, so if you have a $500,000 house, as a homeowner, you're going to absorb the first $50,000 worth of damages from that earthquake yourself before the insurance kicks in. But if there is a catastrophic event where it does $200,000 worth of damage to your house, well, you pay for the first $50,000 worth of damage, and the insurance company covers the next $150,000. But like all insurance, it may have a cap on their liability. And so if your policy is for a maximum of $250,000, if it does $500,000, if it's a complete loss, it does $500,000 worth of damage, you're only getting $250,000 from the insurance company. That's the limit of your policy. And this CRT bond basically does exactly the same thing. It's saying, okay, Fannie Mae and Freddie Mac, if you have a certain level of defaults on mortgages, a certain level of defaults you should be able to handle. Up to 1% of the loans default, you should be able to handle that. There's going to be no insurance for that. But if your defaults go from 1% to 3%, then this credit risk transfer insurance basically kicks in and will cover some of those losses. But the hard part is that the limits on the loss side of things is relatively limited. It's limited up to about 4 or 5% of the total portfolio value. Now, the pro camp on this says that's fine. You don't need it to be more than 4 or 5% of the holdings, because never in history have more than 4 or 5% of the loans defaulted. And that's true. Even back in 2008, when there were short sales and foreclosures and everything else, not everybody went into a short sale. Not every house went into foreclosure. Just the people who had bought at the height of the market who were upside down. But somebody who lived in their home for 20 or 30 years, they still had enough equity. They weren't, in trouble. People who didn't lose a job, kept making their mortgage payments, they weren't in trouble. The problem is with the CRT camp is that the credit risk transfer bond doesn't cover Fannie Mae's whole portfolio. They cover each individual pool of loans as they're sold. So when banks get together and they put together a pool of 1,000 loans and they sell that to Fannie Mae, there is a CRT. What they're proposing is that there be a CRT bond that goes with this, a credit risk transfer bond that goes along with that pool. And that credit risk transfer bond is attached to that pool. And so if you get into an environment where a bunch of people who just bought homes when values were high, if the mortgage, if the, for whatever reason, because the economy or crash or scare in the market, home values drop, well, all the loans in that most recent pool are all going to be loans done within the last 60 days. And so if these are the guys that are all over leveraged, and you're not throwing in loans that are 5 years old, 6 years old, 10 years old, then these ones that just bought at the peak of the market and values drop, those are the most risky. And you might have 10% of that portfolio default, or 20%, because those were the highest risk loans. Those that had just been established, don't have history, were highly leveraged. And so in that case, that 3% limit or 4% limit on the credit risk transfer bond is not nearly sufficient to cover the risk for that individual pool. And so I personally think, from my research on it, I don't think that the risk transfer bond is sufficient to cover a major impact, to cover an earthquake, which is exactly what it's designed to do. It would be like having an earthquake policy with $100,000 worth of coverage. Great, it kicks in, but if that earthquake does more than $100,000 worth of damage, I'm still in trouble, even if I have the insurance.
So in summary, there's a bunch of people who just look at the short term, that if we go private, if they were to recapture any percentage of their previous stock value, even a fraction of it that it used to, maybe jumps to 25, $30 a share, it's worth it. But from your opinion, because of the risk factors it's going to be way more impactful to the real estate market, that it's not worth it, that we're going to take on way too much risk and way too much cost.
Correct. One, you're adding 0.5% to rates. Two, you're absolutely putting in my opinion, you're putting the entire industry at risk. If there is another event similar to 2007, 2008, these CRTs will not have sufficient coverage. And then we're right back to the government bailing them out again. In which case, why did we go through this exercise? The other part of it is just in interest of the taxpayer themselves. I think it's a bad idea, because what people are talking about here is like, okay, well, let's take Fannie Mae and Freddie Mac private. We'll give their the government their money back. Well, that is, in my opinion, wholly insufficient. The federal government stepped in when these companies were at the risk of bankruptcy. Okay, so I'm not necessarily a huge Tesla fan or like a big Elon Musk fan, but you know what? He was bold. And he drove Tesla to the point that Tesla was a couple of weeks away from bankruptcy. Now, the investors who believed in Tesla and decided, hey, I'm going to dump 50 grand of my money into this company that is weeks away from bankruptcy because I believe in it, they're the ones who took the most risk. I have no issue with the fact that they have triple-digit returns on that stock because they took the big risk. But the guy who invests in Tesla today shouldn't be getting 100% return. You didn't put money at stake when it was most at risk. The guy who put his money at stake when it was most at risk should get the highest return. I feel the same way about the federal government. The federal government threw billions of dollars into this thing when it was at most at risk. So telling them that, hey, you get your money back, that is wholly insufficient. The government should be able to earn a proper yield for having taken that risk, not just get their money back. Because that would be an absolute pure bailout for shareholders if they just let them pay the government the money back they put in. The other part of it is that right now, the federal government is getting a return on the money it has invested in Fannie Mae or Freddie Mac. So, for example, in 2024, the federal government earned $19 billion that goes to the Infrastructure Investment and Job Acts that comes from dividends paid on Fannie Mae and Freddie Mac stock. So the government's earning $19 billion a year for the investment Fannie Mae and Freddie Mac. That is on the lowest volume year that we've had in recent memory, because 2024 was not a banner year for the mortgage business. So even on a very low volume, tough year, the government earned $19 billion towards other programs. They had $3.8 billion in profit on top of that, which doesn't sound like necessarily a lot, except for the fact that when you consider how the government calculates profit, they look at what all the capital that they have invested in Fannie Mae and Freddie Mac, and they assume they should be getting a 9% rate of return on that capital. And the profit that they're issuing as profit is only how much money they've earned above and beyond the 9 or 10% that they have, that they say they should be getting for their investment in Fannie Mae or Freddie Mac. So, if the government's earning, let's say 10%, just round it to a 9% rate of return on all the money that they've invested, plus spinning off another $20 billion or $19 billion towards funding over programs, just giving the federal government their money back means that you create a huge hole now.
So here's a big question then. Let's just jump straight to some high points then. Do you think it's likely that this is going to happen?
I don't think it's possible.
You don't think it's possible?
Well, the government has done some shockingly weird things in recent times.
Yeah.
And especially when it comes to the budget. I mean, there are some things that they've done that have just been so dumb that you're like, I don't know what you were trying to do other than make people mad, because, if the government goes into default, then they end up laying people off. They end up having to hire them all back. It just creates drama for nothing, right? So you can never say never, because it's hard to underestimate.
This is the
How
administration
dumb-
that you can't totally bet on it. This is the reason why the market has hedged that there's a chance it could happen, which is why the stock's gone up. Not a ton,
Yeah,
right?
yeah.
Not a ton. But if you're a
Because
betting person, you're saying it's going to stay the way it is.
well, and the biggest reason is not because of the why. If it was just a question of why, then yes, it would absolutely go private, just because it doesn't make any sense. But they're like, we like free market and we're against socialism, so they would do it just for that alone.
But logistically, it's just too much of a nightmare.
Logistically, I don't see how they could pull it off. I don't see how you could pull it off without having some sort of government support for the credit risk transfer part of the market, because why would people buy into that risky of a market with no guarantee on it? And they're playing with CRTs right now, but CRTs, and there are CRTs that are selling. But the hard part is the CRTs right now are this tiny, tiny, tiny portion of the market. So are you able to find enough buyers to soak up this tiny, tiny portion? Yes. But if you take Fannie Mae, Freddie Mac private, that market needs to expand 100 times. So is there going to be that much money available to soak up that much inventory, that much supply of those riskier bonds? In which case, if the government's going to have to provide some sort of support for the riskier bonds, why would you not just keep the companies? Like, why would you let regular investors take the no risk and then you're going to take the heavy, heavy high risk? That doesn't make any sense.
So you don't think it'll likely happen. So let's follow that pathway then. If it likely doesn't happen, in the attempt to try to do so, but maybe falling short, what do you think is the most likely outcome over the next 4 years, over this administration?
There's going to be noise about it, and I honestly, my gut is that this is going to become our new infrastructure week. That we're going to be looking at taking Fannie Mae, Freddie Mac private. We're going to come up with a plan in 2 weeks, and it goes away, and then it's going to be another, hey, we're going to take Fannie Mae, Freddie Mac private. We're going to come up with a plan in 2 weeks. But the devil's in the details. There are so many devils in the details, and it obviously would still have to go through Congress. And
I'll share. I'll share. I mean, I'll piggyback on some of those thoughts. I probably think it doesn't happen either. And I think it's a mixture of that on top of the fact that this administration has made many promises for the next 4 years. And that one is a beast to try to do. And I don't think it shows up as high on the general public's radar, even though it might impact them more than they think it does, because they just don't understand it. As long as they don't understand it, then there's going to be other topics that are going to end up taking precedence. There's going to be some foreign affairs they're going to have to address. There's going to be some, revisions to the tax code. There's that government efficiency they're trying to do, right? But I also say that, that the last time Trump was in office and he did pass that tax bill, I felt very much like there was a lot of like, hey, pay attention to what I'm doing here, so you don't notice what I'm doing here. But that tax bill that was passed in 2017, all that fighting and infighting about the standard deduction, reduction of itemized deductions, and back and forth and back and forth, and it was like, okay, well, I didn't see anyone fighting about this bonus depreciation of real estate, cost segregation studies, and qualified opportunity funds, right? And then as things kind of turned out, they're like, wow, that's a lot of tax cuts for property owners and or business owners who own property and or mixture of the two, right? And it's been a very hot topic amongst real estate investors, ever since. But I felt like very much like the whole reason why the Democratic Party wasn't arguing over that portion of the policy was they just didn't understand the impact of having that tax code. And once it got put in place, we got to see it. I think they might have more of an opinion of it now, but at this point, they don't have they don't have it. They don't have any of the, they've lost most of the control of the government. So I don't think it's going to go anywhere. I think the biggest reason why is because I think that for most of the public, it's not going to draw enough interest. But it's not going to draw. It's going to be too big of a thing to do. But if they did try to do it on the down low, where people didn't really notice, this is the right time to do it. But I just don't know how they're going to. And I think that they're going to just pick something else that might have a little easier that they could tackle during that time frame.
Well, and here's the hard part, as I'm sure Chris will echo at this point. This is not an easy topic to put into a 9-second soundbite. No, it does not fit neatly into a 30-second commercial.
Understanding the financing that's associated with real estate is so heavily impacted to what happens with real estate. We saw that in 2008. We see it happening right now in the multifamily and commercial space right now. There's a reason why those asset classes are getting hammered. Their product looks and feels a lot like subprime in many ways possible. Many features that exist in the commercial world, the commercial financing world, were things that were banned from residential financing in 2008. And those factors, and I think the lending for the purpose of underwriting methods was sound, but it was kind of surprising that people were evaluating these assets so highly based off their cash flow with these low interest rates, not knowing that they're automatically going to get discounted the second rates went up. And now that they've gone up, they have to reset. Now they're worth less, and there's a big correction. To me, it seems as obvious as day. But the market still fell for it, and now there's a big correction. So,
well, and so there's a couple of functional hurdles, so it's like, oh gosh, what was that movie that talked about the collapse of 2008? I'm just spacing on the title right now.
I'm just a couple of them.
Short.
The Big Short, yeah.
The Big Short. Okay, so if you're familiar with The Big Short, right? You know how in The Big Short they were kind of going through, it's like, okay, well, we take these bonds and we put it into a CDO, and then we leverage that CDO, and you do all this.
The bets on the bets on the bets.
The bets on the bets on the bets. That is the CRT market. Okay, that is it is a return to that same kind of thing where you're like, well, we're going to insure risk and we're hoping we never have to pay off it, but we're going to create a bond issue for it and we're going to put money in it and we can leverage that bond. It is kind of a return to that kind of scenario. So, that's why I'm saying that I don't know that bond market is feasible in the present day on a large scale. On a small scale, sure, but on a large scale, I just don't see it. The other part is this is not a revenue neutral thing. If you take Fannie Mae and Freddie Mac private, you've got to figure out where you're going to get another $50-60 million a year into the federal budget, because
that's the other part. I felt like this reminds me a little bit of like the beginning of a federal income tax in the early 1900s. They got a little taste of it. I mean, there's Chris, this is things that everyone who's not in real estate, it's even people that are in real estate but are not in the mortgage world. And I would say a good portion of people in the mortgage world are not really paying attention, but they implemented all these like price adjusters that they called loan level price adjustments, right? That only happened after the conservatorship. And they, for a long time, and I don't know if it's still there and they're just hiding it, they just threw a 25 basis points hit on every loan for the fact that there is a conservatorship, which is basically just saying it's 40 now, which is I just called it an unvoted for tax because it wasn't risk based. It was snuck into this risk based price adjustment calculator, saying, oh well, before you weren't adjusting your pricing as much based off of risk, and so it makes more sense that we have more risk based pricing adjusting in there. Oh, by the way, we're going to just slap on this extra cost on top of it. Where'd all that money go? It was all going to the federal government, right? And you can imagine, like, just go to the math and go look at I don't even know the number. I bet you my boss would probably know the number. Barry, you might know the number. What's the average loan fundings number per year in the agency lending world? Trillions?
It's in 2024, it was 1.9 trillion in volume.
$2 trillion. Okay, let's just do the math here. 2 million, 2 billion, 2 trillion times 40 basis points. That's $8 billion a year in revenue for being a conservator. Like, who are they to want to give that up? Now, for the sake of like, we're going to try to cut government efficiency, right? That's a good argument for cutting government efficiency. But I would argue that the easier in between bet, which would be great for mortgage rates, is if they stayed controlled by the federal government in a conservatorship, and the efficiency team said, fine, you guys could still be the conservator, but you got to cut that 40 bips down, which in today's world equates to almost a quarter in interest rate, right? Give it back to the people. You don't need all that extra money, right?
Yeah.
You know,
Yeah, I see what you're saying, but at the same time, I'm also a person that thinks like, look, the Fed invested billions and billions and billions in dollars. We are actually, if you look at like how much rates would go up for losing our AAA rating, we're borrowing the government's AAA rating for 40 basis points. That's a bargain.
it is, but I
Yeah.
think that it doesn't have to be 40. I think
No,
that you could keep
understood.
I think we could split the difference, keep the
Yeah.
conservatorship, and give some money back.
Yeah,
That's what I think.
and that's a fair point. But I think you're benefiting from the government backing, so it's kind of silly to say we want to benefit from the government backing without.
But I don't think there's any reason why they should have jumped it from 25 to 40 basis points when the market was on fire. You know,
Cash.
yeah, that was that. I mean, and that kind of action can only lead without any kind of regulation into more of the same. That 40 will become 60. That 60 will become 80. Right?
Yeah,
Especially rates on decline.
You hope there would be some discipline on that.
Yeah.
At
So
some point
can I maybe ask a question?
Sure.
And play devil's advocate a little bit.
Mm-hmm.
So I don't know much about what the conservatorship structure is like when the federal government takes over something, but I know in the estate planning world, when a conservatorship is ordered, the conservatorship is only supposed to last as long as the disability lasts. So that may be the biggest reason why the conservatorship should end, because I haven't really heard anything from you guys so far today that the government's actually still needed to run these businesses, just that it's going to suck to unwind them. I don't know if that is necessarily a good legal argument or a good argument in general, because the very nature of a conservatorship is only to provide assistance while it is needed, at least on an individual basis.
No, I think it's a great question. I mean, we're talking about all the reasons why it may not happen, but you're actually asking the most important questions, which is why did we do it to begin with? And if that reason is ended, then why would we not end? Which is part of the argument that's coming from people on Wall Street, right? And Barry's starting to answer a little bit of those questions in layers, but I think that it's like, hey, we solved, we did a surgery that saved your life, and to get through the pain, we put you on opioids, and now we got to figure out how to get you off your addiction. I mean, if you want just a summary of an analogy of that's what we're dealing with, that's what it is, right? And so, and that's money that they're not going to want to get rid of, and they're going to want to hold on to, and there are attachments to the security of certain markets as to why it needs to retain some form of what it is for at least a short, time being. But I guess I'll play another, outcome. We could say that we could split the difference on the on that conservatorship fee, but there also could be an argument that if there was an end to conservatorship, it probably doesn't end up happening in the form of just like rip off the Band-Aid. It would probably have to be done in a period of phases and timing. That way it can be absorbed in the market.
But if you need funding for this, wouldn't you just keep the 40 basis points and call that like an administrative fee and just put that into the company? Like, I think, and I don't know anything about this.
No, that's good. I think it's a good argument.
Like, it's already going somewhere anyway. Why not just keep it and put it back in and then use that to fund?
There's argument that both that and also if there's a large amount of capital invested back into the company when it goes private, that starts to replace a little bit of the government's position, that the combination of those two things helps securitize their position enough that they don't need the government backing anymore. I think it's a little bit drastic because of what Barry's talking about. The bond market it's a market that's based off of fixed securities on safety. Like people who invest in that space are not doing so to get the best returns. They're doing so to protect their money and make a small yield. And so much of that safety and security comes from that government backing. So I think what he's referencing is there's too much of an underestimation of what that security means to the investor. And stock price going up.
What was the status though of the market before the government stepped in, like 2005?
Well, 2005 was a little bit different because people had this kind of, rose-colored glasses about real estate, that it was never going to crash no matter how toxic the mortgages were on it. So anything that was backed to real estate was considered super, super safe no matter what, with not much attention to how it was being done, which has obviously led to the mess that we got into. And we're not going back to that world of kind of being rose-colored glasses and real estate's going to be perfect forever. There's, it's way too fresh in people's memories. For it to go back to that level. I do think people do have short-term memories, but I don't think that it's that short-term that they completely forget about what happened.
Yeah. And I would maybe think about it in different terms too. So people could argue, it's like, well, Fannie Mae and Freddie Mac have been under conservatorship for almost 15 years now, and the government hasn't had to come in and bail them back out. So shouldn't they be out of conservatorship now? Well, hey, how long has Poland been a member of NATO? The U.S. has never sent troops there.
But that's not the standard. What we're talking about here, though, is are Fannie and Freddie Mac financially stable and able to run on their own? I think the answer is yes. At this point in time,
yes. But this is the crux of the whole argument, and this is where the pro camp says yes, they are. Yes, they are. You should let them loose. Okay, but let's talk about what let them loose means. Because let them loose means that, hey, we're not coming to bail you out again.
Maybe. Isn't this a slippery slope into like the government just taking over everything? If we're gonna take this in the other direction, because the banking industry in and of itself has needed to have bailouts before. So like, should the government just step in and take over the banking industry, the auto industry? These things happen all the time. The government steps in and bails everybody out, and then let's go again.
Yeah, real estate's a little different because it's these products are converted to bonds, and the buyer of these bonds, which supports the market, is
but won't they adjust over time? Won't they adjust over time?
The difference,
but they might adjust by just not buying those bonds and buying only T-bills at a lower yield, which will then collapse the real estate market.
Maybe it won't collapse the real estate market. It'll just adjust the interest rates, right, until somebody wants to buy them, just like everything else. Will it be painful in the short term? Yeah, probably.
Yep.
But you know what? That's just like what life is like in the capitalist United States. There's ups and downs.
I think the bigger part of it, though, is that the way the how is the big problem. Because you're talking about creating a private equity market that is going to act as a backstop for the entire mortgage industry. And when you have a private equity market that is now responsible for something that is absolutely critical to the United States economy as a whole, then you're basically saying, hey, private investors, please don't bail on us if things get dicey. And
aren't there many different sectors that would fall into that category that are privately owned? Like basically,
yeah, but the history of those
else?
sectors the history of those sectors are a little different. Remember when I told a little history story about Fannie? Really until 50 years ago, for the first 50 years of its existence, 50 years of its existence, it was 100% just the government. And even then, when it broke off in three ways, and became a duopoly and one monopoly, but because it's truly government-insured home loans, it's fine to do so, retained. And in the first moment that they got in trouble, the conservatorship came back in, which shows that they've never tethered that far away from the government. They've never been, these entities have never really ever been 100% independent private entities. They're attempting to do so in 1971, was always kind of fixated on the fact that it's like, let's see what this looks like now that we finally broke them off. And the first minute they got in trouble, they got bailed out and got a conservatorship, and that's now lasted 15 years. So if you add that back onto the first 50 years of its history, it's these other industries that you're referencing have really operated on a true independent capitalist basis. These were, that version of a true independent capitalist basis in the mortgage industry only really existed prior to the Great Depression. And that was also the beginning of the 30-year fixed mortgage. And, there's a good argument that a true pure private mortgage sector would mean that we get away from that. We have a mortgage system that looks a lot more like Canada, which would make a massive adjustment to what real estate values are, because they're all priced based off of what the payment would be on a fixed basis over a 15 to 30 year period.
What we're talking about going to, though, we already have for like 35 years, right? we're going back, talking about going back to like pre 2007 standard. So it hasn't worked.
Yeah,
it did work for a long time until what happened?
Until it didn't.
Until it didn't.
And that happens for everything, by the way. And it's going to happen again, whether the government owns real estate or not, or owns Freddie and Fannie Mac. It's going to happen again. There are wildfires in LA. There's going to be an earthquake probably in LA because everything happens in LA. But when that happens, when you have these outlying events, the government steps in. And then when it's over, they step back out. They're not going to come in and run LA. They're not going to run the construction industry because, they're doing a better job of it. They're going to come in and help, and they're going to get back out. I mean, isn't that what we're talking about?
Mm-hmm. Yep. And I think that there's a good argument that we should go back on operating the same basis that we did around 2007 and prior, with all the new Dodd-Frank rules that help provide some securitization and safety, that there's still a non-QM space to provide some private mortgage product. And if there's a small bump to interest rates, I feel like, I've kind of hinted to what I thought the right answer is. I think the right answer is to lean off of it, but it can't be a cold turkey.
The fact that the government set up a bad setup when they did this, it's their fault. Like, they should have just taken an ownership interest in this and just run with it, right? This is what Trump is talking about with TikTok. Let's just own 50% of it and we'll just catch all the money off of it. Why don't we just buy it? The government could have done that. Like, I'm not sure why they called this a conservatorship. Like, this, not like this, just we're just looking backwards.
Well, I think it's partially because there was a lot that happened in 1971 to break it off of it. I mean, because at the time it was just one entity. It was Fannie Mae who,
that's right. You're right. You're 100% right.
Ruled them all, right? And so
you're 100% right, and you're kind of making my point.
Yep.
They called it conservatorship on purpose because the idea is to release control once these entities are back in operating condition.
Now we're getting to conspiracy theories. Did they ever intend to ever let go of that control? Or they just call it that to lure us in?
If they didn't, they would have done something different. When they bailed out the auto industry, they didn't create a conservatorship. They loaned money with interest rates to get paid back and make a ton of cash on their investment, which they did. And it worked really, really well.
That's a good argument. I like it. I like where you're going with it.
And they did this. And by the way, the auto industry was bailed out, I think, at the same time that this happened, right? All these things kind of happened all at the same time.
So, which I don't think that, I mean, it's a different topic of discussion, but I don't think that happens again today. I think that the industry has changed enough with new players that the too big to fail in the auto industry is not a thing anymore. I think Chrysler only makes like 2 models anymore. It's like, so it's not what it used to be. But,
so anyway, I don't really, honestly, I'm not in the industry, so I don't know if it.
No, I think you being outside the industry actually gives a really good insight to what we're talking about. Absolutely correct.
I think the hard part with it too is there is, before you go down that path, you have to consider how important is their mandate. How important is having Fannie Mae and Freddie Mac be there as a provider of affordable housing? How much is that worth? Because when you're talking about a 3% down first-time home buyer loan or a 5% down first-time home buyer loan, that is way riskier than a 20% down.
And I think we talked about offline before. FHA would obviously be asked to cover a lot of that difference, but they don't want to increase their market share, right?
Correct. They're trying to decrease their market share. And if you allow Fannie and Freddie to be an exclusively profit-based thing, then these products will honestly, they'll kind of cease to exist.
Well, who in the government is saying they want FHA?
I would disagree. I don't know anything about I don't know anything about your industry, but I would disagree, because before 2007, this is exactly what happened, and everything was fine. So, like, some of these,
FHA's market share was really small in 2007 because they lost so much of the market share.
But what I'm saying is, people were still able to buy and sell houses. Like the market still worked. These private companies still provided whatever they needed to provide.
So let me play devil's advocate. Let me support Chris's argument, Barry. Let me throw a piece at you. What if the conservatorship ended and then the position FHA took related to their market share shifted, and there was a portion of money that came from government-backed loans that went to the Federal Reserve to replace what they were not getting from Fannie and Freddie, because the two could be more tethered together anyways, and the market share could just be more then, because that's what would happen. There'd be a huge increase in FHA financing if the private financing, if Fannie and Freddie would lose a lot of their market share, more of it would go to the government entity, and maybe they just change their position of what market share they need to be. And then,
well, so long as there's a player to absorb that market share. The difference I would take with what Chris was saying is that the system worked in 2005, 2004, 2006, and all that, but we didn't create affordability. We loosened the guidelines to allow for property to be unaffordable, and so we didn't create products that help first-time home buyers. We created products that got first-time home buyers in way over their head. That's what caused the foreclosure crisis. And so left on their own, these private companies didn't. Yeah.
Yeah. And that
but don't you think, though, Barry, that in today's world, and we've already seen that following 2008, that we've learned our lesson in that space, and FHA would represent that stopgap like it did in 2008, moving through 2014, because,
it could, but that's what I'm saying. That there's a discussion to be had. Let's just say, as far as
I think we just figured out the solution. We need to give some. We just need to give 40 basis points of FHA finance to the Federal Reserve, and then pull them off Fannie and Freddie.
So, or basically tell Fannie and Freddie you're going to keep paying the 40 basis points.
And then you and I are just originating a bunch of FHA loans to get people to lower rates. And people are like, just deal with the mortgage insurance. It's cheaper than everyone else.
If you want FHA to take all the risks, then you need to pay FHA for taking off your riskier stuff.
Yeah. I think that's the way it's. I think that's. I mean, technically, unless someone could, at least either one of you could point something to it, but I actually think that's a pretty good solution.
It would be interesting. Yeah. So, anyway,
let's take this podcast episode and send it to the FHFA, the Trump administration, and see what happens. Let's go.
Yeah.
They're gonna be like, that guy doesn't know anything that he's talking about. He knows nothing.
Yeah. Well, no, I think you bring up some really good. I mean, sometimes when you're so deep in the lab, like me and Barry are, that point of view actually really, really helps. It brings up arguments, and we have our automatic counter responses. But then it starts to get the wheels turning of like, what are the real options, right? When you brought the idea that they would just buy TikTok and own half of it, I'm like, well, they're not going to go back to owning half of Fannie and Freddie again. There's a reason why that split happened. But we've already talked about how, if that were to happen, someone would have to absorb that risk. FHA is already designed to do so. Their current mandate is they don't want more market share, and the Trump administration could very quickly change that position and be like, yes, we do, and we're going to position it in a way that the Federal Reserve gets their split, right? So that way they can still get a portion of what they did to help bail them out. And there could still be a sector of support. And the 30-year fixed mortgage doesn't have to go away, right? In the way that it might change a little bit, but there's already a gap right now where FHA financing is cheaper than Fannie Mae, Freddie Mac financing because of the government insurance. And that might just expand further if that were to happen. And if we're just stuck originating FHA loans, I think you and Barry and I were like, hey, it doesn't really hurt us.
I love
right?
FHA.
Yeah, we'll do FHA all day. Bring it on.
Yep, exactly.
They just have to bring up a product that when you put enough down, they don't have to pay as much of insurance, I think, and then they could just really run with it. But then if they did that, they would probably start to be a little too competitive in that same space that Fannie and Freddie are. But
Yep. All right. Well, I think that's probably as much mortgage nerd as your audience can handle for one day.
Yeah.
Yeah.
No, that's a good episode.
Yeah, that was good.
I really like. Yeah,
that was interesting.
Was great.
I don't know much about it. So okay. All right. Well, let's wrap it up.
Yeah.
Okay. If you guys, by the way, have made it this far, thank you for listening, and God bless you, because you are one of one probably. But nevertheless, you probably learned a lot. That's great. This is the Business Barbershop Podcast. I am Chris.
I'm Keane.
I'm Barry.
That's it for today, y'all. See ya.
See you guys later.